83%. That's how much the Nasdaq 100, the index behind QQQ, fell between March 2000 and October 2002. The index holding the biggest, most admired technology companies in the world had one of the longest and most difficult drawdowns in recent history. If you bought at that peak, you waited until 2016 just to break even. That's 16 years. Your $1 million portfolio fell to $170,000 in 33 months. Today, QQQ is just as concentrated in technology as it was back in 2000. So let's talk about what actually happened and what it means for you. In March 2000, the top of the Nasdaq 100 looked untouchable. Microsoft, Cisco, Intel, Oracle, Sun Microsystems. Tech was about 65% of the index. Cisco was briefly the most valuable company on earth. Fast forward 20 years, and of those top 10 holdings, only one, Microsoft, was still in the top 10. The rest, Sun Microsystem, which was actually profitable, earning over $2 billion in fiscal 2000, got sold to Oracle a decade later for a fraction of its peak value. JDS Uniphase lost over 99% and was eventually broken into pieces. Yahoo and AOL, once worth over $100 billion each, both sold to Verizon for under $5 billion. WorldCom collapsed in fraud. Pets.com and Webvan simply vanished. Even the survivors got crushed. Cisco fell roughly 85% and spent over 2 decades below its 2000 high. Amazon, one of the greatest investments in history, dropped 94% from $107 to $6 a share. Ask yourself honestly, would you have held through all of that? So where are we now? Today, the top of the QQQ is Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, Broadcom, Tesla. The top 5 names alone are roughly 30% of the entire fund. Depending on how you count, technology and tech-adjacent companies make up 60% or more of the QQQ, right back in dot-com era territory. Now, the bulls have a real argument, and I want to be fair to it. These companies are wildly profitable. Apple just posted its best quarter ever. Nvidia is growing revenue over 70% a year. This is not Pets.com, that dog turd of a .com company. These are real businesses printing cash. But here's the thing. Sun Microsystems was a real business printing real cash too. Microsoft was arguably the best company on the planet in 2000. Being a great company didn't stop the stock falling 60+%. So here's my opinion as a long-term investor. I prefer the S&P 500 over QQQ, and it comes down to diversification. The S&P still gives you the enormous tech exposure, officially about 1/3 of the index, and if you count Google, Meta, Amazon, and Tesla, you're in the low 40s. You are not missing the AI trade by owning the S&P 500, but you're also holding healthcare, financials, industrials, energy. You have a balance of sectors if tech gets repriced and a sector rotation happens. QQQ gives you none of that stabilizer. Now, do I think 83% crash is coming? No, not really. It's possible that the makeup of QQQ is different than in the 2000s. It might never happen again. I do think a correction is in order, but that could be another 1 or maybe even 2 years from now. But here's what history teaches. In 2000, nobody thought Microsoft could fall as far as it did either. The whole point of a bubble is that the losses feel impossible until they happen. And if something even half that severe hits a portfolio that's 60+% tech, you're potentially looking at a decade or more just to get back to even. Last time, it took 16 years. If you are going to take away anything from this video, it's this right here. The psychology of this is the biggest decider of your future. The .com crash wasn't a bad day. It was roughly 3 years of relentless losses. Quarter after quarter after quarter, your portfolio down 30, 50, 70, 83%, with every bounce failing. There was no let up. And then after it was all said and done, you had 13 more years to get back to even. Everyone thinks they'd hold through that after looking at the long-term charts over the past 30 years. Almost nobody does. Most people capitulate near the bottom, selling at the worst possible moment, and that decision, not the crash itself, is what permanently destroys wealth. The best index in the world is worthless if you can't emotionally survive owning it. And if that idea hits home with you, actually preparing yourself mentally for a downturn before it happens, I wrote a whole post on exactly that: managing your portfolio through a recession and the psychology of getting through it. It's up on my Patreon, The Boring Money Club. Link is in the description. So that's the real question. Not is QQQ a good fund? It's a fine fund in my opinion. The question is, can you sit through what its own history says is possible? For me, the S&P 500's diversification of tech is enough. It has the volatility I can handle for my own risk tolerance and the necessary data to use my indicators for reasonable positioning. And if you're wondering how I put that into practice, you can watch the next video right here. Let me know what you would do in the comments, and I'll see you in the next one.